What drives someone to leave a 14-year career at one of Europe's leading investment banks to start an actively managed fund? In today's episode, we explore that leap from seasoned strategist to entrepreneur and what it takes to build a new fund from the ground up. We'll dive into the vision behind it, the philosophy shaping its approach, and what the future looks like for active fund management. Hi, and welcome to Wealth Insider, a podcast by Performativ. This is where industry meets insight, where we sit down for honest and engaging conversations with voices from every corner of the financial world. Together, we explore trends, strategies, and partnerships that are shaping the future of wealth management. Wealth Insider brings you closer to the people and the ideas that are driving the industry forward. Hi, everyone. Welcome back to Wealth Insider. I'm your host, Christian Lindvall, Global Commercial Director at Performativ. Today, I'm joined by a very familiar face in the finance world, Peter Garnry, who you may recognize from his appearances on CNBC and Bloomberg TV, where he shares his insights on international markets. After 14 years at Saxo Bank, where he was most recently the Chief Investment Strategist, he made the bold move to leap out into the world on his own and co-found Gesda Capital, which is an actively managed fund with a fresh take on how active investment should be done. Peter, welcome to the show.
Thank you very much, Christian.
Yeah, thank you for joining.
Thank you.
Lots to get into today, especially interested in your transition from Saxo to entrepreneurship. But maybe we can start your origin story. How did you get into the world of finance? Was this always the career path you were deciding on?
I think that I have two events from my childhood that sort of resonates or is a recollection of my interest in finance. So the first one was my dad's newspaper. Always on the back side of that, there were all these numbers like currency pairs and stock prices. And I just remember, I think maybe I was 10 or 11 years old. So what does these numbers mean? Why do we pay so much for a British pound versus a Deutschmark from Germany? And my dad, being educated as an engineer, he was not interested in finance. He couldn't give me satisfactory answers to that. But I knew there was a bigger world out there and connected world through prices. And then when I was 18, my parents had been so sweet to create some savings for me. So those savings were released when I was 18, and I quickly, that was in the early days, like 2003, when the electronic stockbrokers came about. So I very quickly opened up an account with some of these new stockbrokers and started investing in stocks. So it always was part of, I think, who I am. I just felt a connection to it.
Yeah, amazing. And you actually spent 14 years at Saxo Bank. I referenced that before. By any measure, that's a long time at one place. What sort of kept your curiosity to stay in one place at a place like Saxo?
Yeah, I mean, the learning curve, 14 years, it's a long time. The learning curve in itself made it quite an interesting journey, I would say. So I came in, I was 25 years old. I came in as a regular equity strategist, commenting on the equity market and the markets. And after 2 weeks being there, the PR chief, he comes to my desk and he says, in 2 days, you go on CNBC. I was like, okay. I was not prepared for that. I was very young, not very skilled at that time. So I was just constantly pushed. And then we had an extremely curious team at Saxo in the strategy team. So we learned a lot about the markets and how they are connected. And over the years, I got super interested because there was a former colleague that he was very deep in macro and was doing this statistical work in a programming language called R. And I was immediately fascinated. I was really STEM interested in high school. So I loved physics and math. So I was drawn to the programming side of that. And then eventually that transitioned into a quantitative trading strategies team that I was a part of and led. And then in the end, I was the chief investment strategist and was basically the one in charge of the whole strategy team. So it was always evolving, always new things, and that's what markets are. I mean, it's never changing, right?
But I guess maybe the culture of learning at Saxo, where you're going from sort of a junior position to chief investment strategist, what is the learning culture there? Is it just like you jump into the deep end and need to learn very quickly, or is it more structured, organized around seeing somebody like you have that sort of career growth?
It was not the latter, because our team was the team at Saxo with the highest seniority or people working there for the longest time. We had an average, when I ended, we had multiple people that had been working there for 15 years. So we were a team that went back a long time, and we had this, I think at Saxo, because we didn't have any corporate finance division like, let's say, at Goldman Sachs, you didn't have all these interests or relationships that you need to take care of. So we could ask questions, say things in the media and to clients that probably you wouldn't do as Goldman Sachs. And that was really refreshing. And that learning curve was just very steep. And the markets over those 14 years I was there changed so dramatically. When I came, immediately we talked about the euro crisis, and then it evolved. We talked about technology. Then came the geopolitics with China and Trump. Then COVID. All these things that kept changing the narratives and the beliefs, and that's the thing when you run a team like that, you need to update yourself constantly. So that's why I stayed for 14 years. It was always fun, very thrilling, and a steep learning curve. So, and I think, being in a strategy team where you have experts in commodities and bonds, currency, central banks, the economy, equities, myself, you get this very broad understanding of how the world is connected, and you get a very different perspective on things, which I thought was just very intellectual rewarding.
Yeah. And then as your last role as Chief Investment Strategist, you led a team that covered anything from equities to bonds. What was the biggest learning that you had in that time on leading a team like that?
I think the biggest learning was the world is very noisy and is very complicated. And it became and is much more complicated today than it was when I arrived in 2010, because prior to the first Trump administration, geopolitics was not a big thing. Today, geopolitics is a beast that everyone has to think about and be aware of. So trying to take this very high level connection and understanding of everything, and then try to bring it down to convey that message and that understanding to people that don't read as much as we did or do. And so I think that was one of the key learnings. And then I think one of the learnings also was that people underestimated inflation because it hadn't been around for 40 years. I think that's one of the things in the last part of my experience with Saxo we got completely right compared to a lot of others. And then the final thing, which is interesting because of what I'm doing today, is that a lot of investors simply just getting growth wrong. I mean, I think growth for the 14 years I was at Saxo was completely priced the wrong way, and probably still is priced the wrong way in markets.
Then maybe we can switch to the transition from Saxo to entrepreneurship. This is really interesting to me. You have this sort of relative safe space in a way for 14 years at Saxo, where you're learning a lot, you're rising through the ranks. What sparked the decision to jump out on your own?
Well, you said it a little bit in the beginning, like 14 years. I mean, I had a dad that was 40 years at the same company, but that's very engineering type thing here in Denmark. I think for that generation, I was pretty well aware of that. I wanted to do something different. I had been doing a startup before very early on when I was in university. So I did as well in high school. So I had that entrepreneurial mindset already. And I had been thinking about it before I left Saxo. I had been thinking about what was the next transition for almost a year. And I was bouncing off ideas and was thinking about what was the next step. And then before I became proactive and doing anything, Saxo sort of presented a new idea or a way for the strategy team and the future, which I couldn't see myself in to the same degree as before. So I said, okay, let's do, and it was very uneventful, a happy divorce. I left Saxo, and I actually left it without a 100% clear vision or plan for what I wanted to do. So I came off Saxo and super happy, look back at 14 great years, and then I was to figure out what to do. And that was amazing, because the first couple of months I had tons and tons of meetings with so many people in the industry. I started my own Substack, because the one thing I knew was that when you're a strategist, you write almost daily, every third or second day. I love to write. I love to express my ideas and help other people share my insights. And so that I knew I wanted to do. So I quickly started a Substack, which I'm still doing today. And then I took all these meetings, and there I quickly realized that, okay, I could go into another company, but I could also just start something new. And what I figured out over all these conversations was that, having worked in a strategy team like Saxo with all these different experts in different domain, I had a very unique framework for looking at equities. Like the traditional way, if you do an equity fund like we do today, is that I'm a classic stock analyst. I rise through the ranks in a company. I become a portfolio manager, and then one day, if I have the luck and the skill, I probably do my own thing. And I have a little bit of an untraditional way into the industry, but I understand all the in and out of the the DCF modeling and all these things, but I couple it with the broader understanding from my experience at Saxo, and that revelation, that I have a unique skill set. I thought to myself, okay, let's do something that is really wild here and something that not a lot of people in Denmark wants to do.
Very, very interesting. So I think so many people have this entrepreneurship streak in them, that ambition to be an entrepreneur, but oftentimes taking the first step is the hardest. It didn't sound like you necessarily had a mental hurdle to that by the time you decided to go that route, but what are some of the practical hurdles you encountered as you started your own firm?
Yeah, so the mental hurdle was very quickly done with, and also I think economically I had prepared myself. I always knew that I had one company, a great shot. We did a financial software company. We sold software to banks, and then the Lehman Brothers event came. It became very hard. Eventually, I transitioned out of that startup and ended up at Saxo. So I always knew that I want to do this one more time with more experience, better foundation and capital and all these things. So mentally, I was prepared, and I think actually it's such a thrill actually to start a company when you're 40 years old, because you have all these connections and knowledge, relationships to people that can help you. I had a very clear idea of, okay, this is the branding we want to do. These are the structures we want. This is the coding foundation for the company. This is the type of the strategy we wanted. I was pretty clear about a lot of things, so it never really felt like a big thing. And then I said to myself, okay, what's the worst thing that can happen, right? You do it, you go for it. You're 40 years old. If it doesn't pan out well over 2 years, you can you still at a sweet spot in your life. You can do something else, right?
And kind of amazingly clear-minded. I think it sounds like you spent 14 years sort of building the foundation to start your own thing anyway. So by the time you got it started,
Exactly.
you're ready to go. All right. So having spent many years in a large structured organization, which might be a bit of a misnomer, I spent 7 years at a very large business in the US, and it's not always that structured. It's kind of mostly chaos, just with a lot of financial backing. But let's go with the theory that everything was structured and organized. What's surprised you most about starting your own firm?
I think that what surprised me the most, I had an idea of it already, but was the productivity increase as an individual. And you know this, Christian, when you work in a large organization, what happens is that as a company grow in size, a lot of bureaucracy and systems goes with it, and it slows down. There's a ton of meetings in big corporations because there's a lot of planning and decisions to be made all the time. So when you start a very lean company like we have done this time, and with all the technology that is available, I'm really surprised about how efficient you can really be. So an example is like all the all the all the systems behind when we do trade instructions, we do trade reconciliations, P&L, trade plotter, when we do the risk analysis of the portfolio. All of these things we've built in-house at Gesda Capital, and that's built on my coding experience, but moving outside Saxo, I quickly could enable that with large language models, and I was pretty surprised how much could be done with a single person, and also in other domains, because as soon as you remove all these meetings, you remove all this bureaucracy, your decision making is super fast, and that's my biggest hope, is that all this new technology that's available to young people, but also people of my age, there's tremendous amount of opportunity to go out and challenge some of the big companies, because Saxo is not really big in the grand scheme of things. I mean, it's like 2,500 employees. It's nothing in the bigger world. So, but yeah, so go out and challenge the big companies. I think it's more possible than you actually think.
Absolutely agree. But let's talk a little bit about Gesda Capital then. How would you describe your investment philosophy?
Well, the investment philosophy stems from our mission, which is pretty bold. So we want to build the most high conviction global equity fund in Denmark, and prove that a concentrated thematic approach can beat passive over decades, not quarters. That's sort of that's the mission statement. That's why we're here. And from that mission statement, the investment process flows naturally. So the investment process and strategy is that, okay, we want to do a concentrated portfolio on equities. So it's almost like private equity, just in public markets. Why is that? Because if you look over the past 15 years, the active management industry on equities have been an utter disaster, been completely killed. Too high cost. A lot of them are using the wrong tools. They're over diversified as well, and they are what I call label constrained. So I'm only a growth, I'm only a value, I'm only small, I'm only large, I'm only US. And we want the most free, most unconstrained but concentrated portfolio out there. So that's the investment sort of framework, and then it starts by inverting a lot of the things. So a lot of classic equity managers start with a firm belief in certain characteristics that needs to be fulfilled before we go and invest. So they start with screeners. Well, we exclude all companies that doesn't grow faster than X and doesn't have a return on capital that is better than this and should be part of these sectors, etc. We start from, and that's back to my background at Saxo. We start with, okay, what is the world going to look like? What is the big vectors into the future where you can have pretty predictable demand drivers for that type of theme? So it could be cybersecurity, it could be European rearmament in the defense sector. All these different themes, we identify them. The next layer is then figure out what companies gives the best exposure to that long-term theme, and figure out among those companies who have the greatest superpowers. It's a different word for basically who has the best competitive advantage position in the industry. Then level 3 is probably where a lot of equity managers and analysts start. Then we do the valuation model. And the reason why we not really interested before that in step 3 and not really that obsessed about the valuation and the PE ratio and all that is that, like, you never call a a real estate broker in Copenhagen and tell them, give me the 3 cheapest apartments you have in Denmark or in Copenhagen. Okay, but then you'll end up in these very not very nice looking areas. And so you have to start from the top, predictable demand drivers, where the future is going, find the highest quality in terms of competitive advantage, and then you do the valuation. After step 3, we have a 4th layer, which is called a checklist. So it's like a pilot before takeoff. You have certain criteria, honesty and credibility of the management team. The company needs to grow faster than the overall nominal economy. There's certain thresholds for return on invested capital. You have all these things on the checklist. We go through them. Most of our investments cannot tick all the boxes. And then the 5th one is, so what you get from modeling a company is that you can get to what is the expectation set that is priced into the company on the stock. So the 5th layer in the investment decision is, do we think this company long-term can actually beat those expectations that are built into the stock price? And if we can say yes to all these 5 layers, we go ahead with an investment.
So when you set out to build Gesda Capital, what type of investors were you looking to target?
So when you do a concentrated equity portfolio like ours, you cannot wrap it into the UCITS framework here in the EU. So because there you have all these criteria and constraints on diversification of the portfolio. So go really concentrated, you have to go with what is called an alternative investment fund. And as soon as you go that way, you market it to semi-professional and professional investors with a minimum investment of 100,000 euros. There is a path and a gateway in the regulation to open up an alternative investment fund for the broader audience, given certain conditions. So it's not our first priority, but it could be very well that like 3-4 years from now that the fund will be open to even more people with less minimum investment. So we'll see. But right now it's about building this concentrated portfolio, proof that it works, and that's also the connection back to our name. So what is Gesda Capital? Well, Gesda Capital is a play on the name of the first history book of Denmark and Scandinavia, which is called Gesda Danarum, which means the deeds of the Danes, which was written by Saxo Grammaticus. And the link is that my co-founder Julius and we met each other at Saxo, and Saxo took its name from the author, the Saxo Grammaticus, the author. But there is also this idea that you have to leave the shore of what you know to gain and conquer something. And that's sort of what lies in what the Vikings did. So there is that connection to that. We're doing something that is very, very different from what a lot of people are doing in the industry. And I think you just have to do it if you want to change things.
You've written about the need for more active and data-informed strategies in a world increasingly informed by algorithms. How does Gesda Capital strike that balance?
That's a very good question. So I think that the market has become extremely efficient with a lot of data sets. And that takes place in the short end of the investment horizon. So the shorter the investment horizon, the more it's dominated by algorithm and super advanced quant firms out of New York and out of London. It's a very tough game to win. I think as you stretch out the investment horizon, which we do at Gesda Capital, there are other factors at play, which I think plays to an advantage of what we are doing. We still use a lot of data. We use a lot of AI technology to go really, really deep to understand the companies. We tap into our information network as well to understand the companies. But then the data, that's the alpha part. So in the alpha part, we have this hybrid model. We have our own framework for how the world is evolving geopolitically, politically, economically. We use all this data on the companies, but then where it gets really data intensive is on the risk side. So on the risk side, a lot of traditional, or not traditional, but a lot of equity managers, they have this mindset that nothing beats 1 over N. So what is 1 over N? Is if you have 10 stocks, you put 10% in each, and then you just let it float from there. So we say there's a better way because there's a selection bias in 1 over N. If you pick a lot of stocks from the financial sector, then 1 over N could give you a very clear bias towards the financial sector. So what we do instead is that we have the different themes. We try to make them not overlap too much. Then step 2 is to have a very great and fine balance on business model. So if you're a value investor, you typically end up in very capital intensive industries. If you're a growth investor, you typically end up in asset light type companies. We want to strike the balance across the entire curve, so have different business models. And then step 3, a lot of machine learning to create and identify the clusters in our stock positions and then allocate risk equally to these clusters. And then within the cluster, we use our own algorithm where we tilt the portfolio weights towards the characteristics that we like, basically.
So how do you see Gesda Capital fitting into the broader wealth management space?
There has been an evolution in the wealth management industry going back all the way to 2010 when I joined Saxo. So the whole evolution and the lower cost structures in ETFs have enabled the wealth management industry in an incredible way. It has been a dominant force in accelerating the use of passive funds, but you've seen an evolution towards this core satellite approach, which I'm very much fan of, because what you do in the core satellite approach is that let's say you allocate 70% to the core portfolio. So the core portfolio, you create an asset allocation built on very cheap components, so passive vehicles at very low cost, and then you add satellites around the core, which tilts the portfolio, amplifies certain things you want. So Gesda Capital's portfolio would be one of those satellites where you would say, okay, within my equity allocation, I will maybe be 70% of my equity allocations to passive, and then I'll find a couple of managers or thematic ETFs or whatever you want to do and put that on as a satellite. And we fit into that. So very rarely we would have an investor where you said, okay, sure, I'll give you 100% of my equity allocation. That's not typical investor. So we are a bolt-on component, and we have great talks and relationships with wealth advisors and family offices where we can sort of play a role in enhancing the returns long-term for these clients.
All right, so let's look ahead a bit. As you continue to grow Gesda Capital, what are you most excited about?
I'm really excited about the journey ahead for a lot of the companies that we have invested in, also because the investment horizon is long. And all the companies we have invested in are part of long-term, super interesting themes that will run in this world for the next 10, 15, 20 years. And I'm super excited to see how big these companies can be while we are part of that journey. I'm super excited about that. And then I'm excited when we get to the next journey, because we have a bold mission statement. And another boldness we have around our company is that we want to be something as well for people outside Denmark. So the curious thing about Denmark is that this country has produced a lot of great capital allocators in infrastructure, credit, real estate, etc. We have had a few in equities, but you cannot historically point to an equity fund out of Denmark that really was a name. In Sweden, you have Brummer funds. In Norway, you had the Skagen Fund. You have all these different companies around Europe that made a dent in the European investment landscape, and nothing on equities came out of Denmark. Whether it's cultural, I don't know. Those that have been successful in the past sort of stagnated, and the other ones that are successful very much live in the shadows. They don't engage in the public conversation. I think that is where I think Gesda Capital will be very different. We want to participate and be very opinionated about what works and what doesn't work and where the world is moving. And the big vision is to get across the border in Denmark and become a big important capital allocator in equities in Europe over time.
Cool. For a final question, I'd like to maybe go back to the entrepreneurship topic. What's the best piece of advice you can give somebody who's looking to enter into a world where they're starting their own thing from scratch?
I think it's, of course, build up the skill set and plan it as good as you can, but it's so unpredictable anyway. You always have a plan A, and then we go for plan B now, and that didn't work, and then plan C. You can listen to all the Silicon Valley people that have started companies. The world is extremely unpredictable, so maybe get rid of the fear and just try to do it. And I always remind myself also when I had my first company, like this very interesting video with Steve Jobs. It's a video he does backstage back in the days in his early companies, Apple, where he says that the defining moment for him when he figured out or learned that the whole world and what we call life you see today is just made up of people that is no smarter than you, right? And as soon as you figure that out, you can change the world and you can actually build things, right? So I think if you can sort of apply that mindset, I think you will be surprised how much you can actually change your own life and trajectory and build something.
That is a fantastic piece of advice. I think we should end it there. Peter, thank you so much for joining us today. We really appreciate it.
Thank you.
That's it for today's episode of Wealth Insider. If you enjoyed this conversation, be sure to subscribe to the show wherever you get your podcasts. You can also find more insight on Performativ.com, and we'll be back soon with more conversations from the people redefining wealth management.